The international banking system remains a complex and multifaceted network. Globally, over 30,000 banks manage vast asset portfolios. The top 10 banks control approximately $25 trillion. While modern banking appears intricate, its foundational concept aimed to simplify financial interactions. The origins of banking. In 11th century Italy, a hub for European trade, merchants faced the challenge of handling numerous currencies. In Pisa alone, traders dealt with 7 coin types, necessitating frequent exchanges. The term bank originated from the Italian word banco, referring to the benches where currency exchange occurred. Concerns about travel risks, counterfeit currency, and loan accessibility spurred innovation. Brokers began offering credit to merchants, and Genovese traders pioneered cashless payments. Banking networks expanded across Europe, providing credit to entities including the church and European royalty. Contemporary banking banks operate primarily in risk management. They accept deposits, paying depositors a modest interest, and then lend this capital at higher interest rates. This involves calculated risk, as some borrowers may default. Banks generate income through savings deposits, credit card services, currency exchange, custodial services, cash management services. This process is vital to the economy, providing resources for purchases like homes and enabling business expansion. Banks essentially channel unused funds from savers into investments that drive economic activity. Issues in modern banking. A significant issue in contemporary banking is the shift from traditional long-term financial products to high-risk short-term ventures. During financial booms, many major banks engaged in complex and poorly understood financial constructs and speculative trading to generate quick profits, resulting in substantial bonuses for executives and traders. This behavior, akin to gambling, has damaged economies and societies. The 2008 financial crisis exemplified this, with institutions like Lehman Brothers extending credit to virtually anyone seeking to buy a home, leading to extreme risk exposure. This precipitated a collapse in the US and European housing markets, causing stock prices to plummet and triggering a global banking crisis and a major financial downturn. Trillions of dollars were lost, millions lost jobs and savings, and banks incurred billions in fines, severely damaging public trust. Governments in the US and the European Union implemented large-scale bailout packages to stabilize banks by purchasing toxic assets and preventing bankruptcies. New regulations, including mandatory bank emergency funds, were introduced to buffer against future financial shocks. However, lobbying efforts by the banking sector successfully blocked other stringent legislative measures. Alternative financing models. Alternative financing models are increasingly popular. Investment banks that charge annual fees rather than sales commissions are gaining traction by aligning their interests with those of their clients. Credit unions, established in the 19th century, provide financial services with a focus on shared value rather than profit maximization, helping members achieve goals like starting businesses or building homes while reinvesting in communities. Credit unions are controlled by their members, who democratically elect the board of directors. Credit unions survived the 2008 financial crisis better than traditional banks due to their focus on member benefits, which influences their risk tolerance. Crowdfunding has also emerged as a significant force, enabling individuals to secure loans from numerous small investors, bypassing traditional banks. Platforms like Kickstarter and Indiegogo have facilitated the launch of new technology companies, allowing funders to invest in ideas they support while spreading risk. Microcredits, small loans primarily in developing countries, help people escape poverty by providing access to capital for starting businesses. The future of banking. The role of banks in providing funds to individuals and businesses remains crucial for society. The question of who will fulfill this role and how it will be done in the future remains open one. Looking ahead to 2025, the banking industry faces a shifting landscape with evolving technology, changing customer expectations, and new global priorities. Factors to consider include fintech integration. Increased integration between banking and financial technology will support the digitalization of the financial industry and closer alignment with the real and digital economies. Digitalization customers are demanding seamless, personalized digital services, and younger generations prioritize transparency, social responsibility, and sustainability. Alternative financing. Alternative financing models are becoming increasingly popular, offering flexible, fast, and innovative solutions. Regulatory landscape. The global banking industry will likely face continued tight regulation, particularly in risk control and fintech innovation. Risk management. Banks must prioritize risk management to address strategic, operational, price, liquidity, and reputational risks. The industry is seeing a move toward green investments and sustainable financing, aligning with global climate goals, as well as evolving regulations and digital currencies reshaping financial services. The use of AI is also expected to grow as well,